Hedge funds. They sound complicated, right? Like a secret club where only the elite get to play. Like something only Wall Street hotshots with slicked back hair and million-dollar suits need to worry about. But what if I told you that understanding hedge funds isn't as daunting as it seems? But let's face it, we're all curious about money. We all want to know how to make it, how to grow it, and how to keep it. And hedge funds, in their own mysterious way, are all about making money. Big money. They are designed to maximize returns, often using strategies that are not available to the average investor. Imagine a regular mutual fund. You pool your money with other investors, and a manager invests it in stocks, bonds, or other assets. Pretty straightforward, right? You get a diversified portfolio, managed by professionals, and you hope for steady returns over time. It's a tried and true method for many. Now, picture a hedge fund as that mutual fund's cooler, more exclusive older brother. The one who takes more risks and sometimes reaps bigger rewards. They both invest money, but hedge funds play by a different set of rules. They have more freedom to use complex strategies. Hedge funds are like private investment clubs. They're not just for anyone. They're for those who can afford to take bigger risks. They're open to a select few. Wealthy individuals and institutions willing to pony up significant sums of money. We're talking millions, sometimes even billions of dollars. Think millions, sometimes even billions of dollars. Why so exclusive? Because these funds take on more risk, using complex strategies to try and generate outsized returns. Because these funds take on more risk, using complex strategies to try and generate outsized returns. They employ techniques like short selling, leverage, and derivatives. Now you might be thinking, risk? That doesn't sound too appealing, and you'd be right to be cautious. That doesn't sound too appealing, and you'd be right to be cautious. Hedge funds can be volatile, and not every strategy works out, and you'd be right to be cautious. But that's the thing about hedge funds. They're not for everyone. They're for those who understand the risks and are willing to take them. But that's the thing about hedge funds. They're not for everyone. They're for those who want to swing for the fences, aiming for home runs, even if it means striking out sometimes. They're for those who want to swing for the fences, aiming for home runs, even if it means striking out sometimes. It's a high-stakes game, but for some, the potential rewards make it worth the risk. So, how do these hedge funds actually work? What makes them so intriguing and, at times, controversial in the financial world? What magic do they possess that allows them to deliver such potentially high returns? Is it some secret formula or insider knowledge? Well, it's not magic, it's strategy. These strategies are meticulously crafted and executed by some of the sharpest minds in finance. And these strategies can get pretty complex, involving a whole bag of tricks that regular investors might not even know exist. From statistical arbitrage to global macro, the range is vast. One common strategy is called long-short. This is a fundamental approach that many hedge funds use to balance risk and reward. Imagine betting on both sides of a horse race. It's like having a stake in both the winning and losing outcomes. You pick one horse to win, going long, and another to lose, going short. This way, you hedge your bets, reducing potential losses. If your picks are right, you win big. The returns can be substantial, making this strategy quite appealing. If not, well, you get the picture. The risks are always there, and sometimes they can be significant. Hedge funds do this with stocks, betting on some to go up and others to go down. This dual approach helps in managing market volatility. Another strategy involves using leverage, which is basically borrowing money to amplify your bets. This can magnify both gains and losses. Think of it like using a credit card to buy stocks. You're essentially using borrowed money to increase your investment potential. If the stock goes up, you make more money. The returns can be significantly higher than if you had used only your own money. But if it goes down, you owe even more. Risky? You bet. The stakes are high, and the potential for loss is equally significant. But that's the hedge fund game. It's a high-risk, high-reward environment where only the most calculated strategies survive. The ultimate goal of most hedge funds is to generate alpha. This is the measure of performance on a risk-adjusted basis. Alpha is like the holy grail of investing. It's the extra return that a fund earns beyond what the market would typically provide. It represents the excess return a fund makes compared to the market average. Achieving alpha means outperforming the market, a feat that requires skill and precision. It's like getting a higher score on a test than everyone else, even though you all had the same textbook. It signifies superior performance and expertise. In the end, hedge funds are about smart strategies, calculated risks, and the relentless pursuit of outperformance. They are not for the faint-hearted, but for those who thrive on challenges and complexities. With all this talk of risk and complexity, you might be wondering why anyone would even bother with hedge funds. The financial world can seem daunting, filled with jargon and high stakes. Well, the answer, as with most things in life, is money. The allure of financial gain is a powerful motivator. People invest in hedge funds for one primary reason: the potential for enormous returns. The possibility of making significant profits is what draws investors in. Remember that alpha we talked about? Alpha represents the excess returns that hedge funds aim to achieve over the market benchmarks. That's what gets investors drooling. The idea of outperforming the market and achieving higher returns is incredibly appealing. Hedge funds aim to deliver returns that are not only high, but also uncorrelated with the market. This means they strive to make money regardless of market conditions. This means that even when the stock market takes a nosedive, a well-managed hedge fund might still be making money. They use various strategies to hedge against market downturns. Of course, these high-potential returns come at a price. Investing in hedge funds is not cheap. Hedge funds typically charge hefty fees, often a 2% management fee and a 20% performance fee. These fees can eat into the profits. This 2 and 20 structure means investors pay a percentage of their assets under management and a cut of any profits the fund makes. It's a significant cost, but many believe it's worth it for the potential gains. So who are these investors willing to shell out big bucks for the chance to hit the investment jackpot? They are typically those with substantial financial resources. We're talking about high net worth individuals, people who have significant assets and are looking to grow their wealth even further. Endowments, which are funds or income sources set aside for specific purposes, often by universities or other institutions, and even sovereign wealth funds, which are state-owned investment funds used by countries to manage their national wealth. These are not your average Joes investing their spare change. They are sophisticated investors with the means and the appetite for high-risk, high-reward opportunities. Hedge funds employ a vast arsenal of strategies, each with its own unique risks and rewards. Let's take a peek at a few of the most common ones. Global macro. These funds take a top-down approach, betting on macroeconomic trends like interest rates, currencies, and commodities. Imagine predicting that the price of oil will skyrocket or that the US dollar will weaken. Global macro funds make these kinds of bets on a grand scale. Event-driven. These funds try to profit from specific events, such as mergers, acquisitions, or corporate restructurings. They analyze these situations, looking for opportunities where they can buy undervalued assets or short overvalued ones. Quantitative. These funds rely heavily on mathematical models and algorithms to identify trading opportunities. They crunch massive amounts of data, looking for patterns and anomalies that can give them an edge. Activist. These funds take an active role in the companies they invest in, pushing for changes they believe will increase shareholder value. Imagine a hedge fund manager becoming a major shareholder in a company and then demanding a seat on the board of directors. That's activist investing in action.